Guys, welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. My name is Alex Cho, and today I'm just going to go ahead and analyze the markets into the weekend. First of all, the Dow Jones Industrial Average closed negative on a Friday. Pretty bad considering the fact that we've already had a downtrend and you couldn't get a short cover rally on a Friday. Again, typically markets like to get some sort of a bounce into a pullback. Again, sorry, I'm sort of in public right now. I'm just hanging out outside and recording a video, so there's going to be a lot of background noise. Friday, it initially had a nice little bounce, again, some short covering, and then we sold off into the evening. Not much surprising there. I don't anticipate this market to recover anytime soon. Main reason why, markets don't trade on the anticipation of what's going to happen in the next couple months, but in reality in the next 2 years. So if you expect good retail sales for the winter session, great. I anticipate that too. Do I anticipate a weaker economy broader over the next 2 years? Definitely. So again, markets are the most accurate leading indicator of how the economy is going to do. Main reason is that the people trading these markets are super geniuses at these major Wall Street firms. If they give the order to sell a share in a company or to sell the market, you bet you they will. Whether it be Goldman Sachs or Morgan Stanley, these people are absolute geniuses. So again, the main reason why markets sell in anticipation of economic downturns is because of insider information and people that are substantially smarter than your typical person when it comes to trading markets. Okay, moving on, the dollar index has had a nice little bounce. What an incredible move. It's gone all the way back to around 79.59, which is a double topping pattern, technically speaking. We kind of touched it, the first touch of it, we had a small little pullback on the dollar index. Not too bad of a move. But I anticipate us to have a small pullback, mainly because of some rally, short covering. Again, if there's another negative event coming out of Europe, which I wouldn't be surprised if there was, you could easily see the dollar index continue to go right above that $80 level, quite easily. Again, this is just typical market behavior. If we had another negative event, I really wouldn't be surprised at this point what would come out of Europe. All right, Euro US dollar, it was able to have a nice little short cover rally bounce, but it wasn't really that great. I think this short-term downwards move is going to be abated for at least a couple more days. Maybe it'll continue lower. I'm not exactly certain, but we'll see what happens over the the Sunday night session in Europe and Asia. So again, we'll get much better information going into the Monday session once we look at what happens on the international markets. In my personal opinion, I honestly think these markets can go substantially lower, but we will have a nice little support area right on that double bottom area on the Euro US dollar. Okay, moving on, the Euro Japanese yen. Again, still a strong downtrend. A lot of people are converting their euros into the Japanese yen, and it's causing the euro to basically weaken. Not too surprised there. I've been saying this for weeks now. If you want to protect your money, and if you're a major investment firm with billions and billions and billions of dollars to lose, if not trillions of dollars to lose, you're going to take your money, you're going to convert it into the Japanese yen, and you're going to buy Japanese treasury bonds for currency appreciation and bond appreciation as well. Let's move on to the next chart. It's going to be the gold market. Gold market is continuing to go lower. We've gone over this before. The main reason why it's continuing to go lower is very simple. Gold likes to go down, especially when markets like the dollar like to go up. So if markets go up, especially in the dollars and the currencies markets, it means that there's a lot of currency shrinkage, or basically the amount of currency is reducing at a rapid pace. When you see that happen, there's less available currency for gold to be bought up, and therefore gold will pull back. Gold is a very large market. I believe it sits at around $5 to $10 trillion in total nominal value. And the total free-floating currency in the world, I think the M2 number sits somewhere close to around 5 to 8 trillion bucks. So it's not too much. There's not a lot of money to go around to be buying gold right now, and it's no surprise to see gold pulling back. Again, these markets are trading in anticipation of what may happen in the next couple of years. It's not an expectation of what's going to happen in the next couple of months. So if you see great retail sales going into this winter session, again, don't be surprised. I've seen this countless of times, many years of experience. I've seen markets pull back after we've had seemingly great results. The main reason is, while everyone's buying into this whole entire fevered hype, the people that are selling are the geniuses on Wall Street. And I'm not talking about your typical average Joe Schmo. I'm talking about people who know so much about markets, who've been in the markets for over many decades, who've seen every type of pullback, and basically know how to react accordingly to everything. Okay, these guys have insider information. They basically have all of it. So don't be surprised if these markets pull back, because again, we're going to have some great results over the short term, but over the longer term, the economy will regress back into a major recession. Um, a lot of companies, there are going to be a few companies that are going to be stalwarts, like Apple, who grew throughout the Great Recession. But even if a company is growing at a rapid rate, it doesn't change the fact that if the overall market wants to sell stocks, it's going to sell the stocks, and it's going to deflate the value of all assets, regardless of how well the equity performs. So again, just anticipate all of that moving in. Now, I am a huge bear on the banks, and I've talked about this before. Main reason why I'm a huge bear on banks is because banks are losing billions upon billions of dollars in the bond market. Now, bonds are what I would call the biggest atomic bomb to a country and a bank's balance sheet, mainly because if your bond portfolio depreciates by 10 to 15% and you lent out $500 billion to a government and you hold on to around $2 trillion in assets that you borrowed from your clients, or basically your deposits, and then they depreciate by 20 to 30%, you have no choice but to sell your bond position, which causes interest rates to go higher for the government, which implies deflation. And another thing that happens is that what it all boils down to is just humongous losses. If you lost 20% of a $500 billion bond portfolio, you lose $100 billion. And there's no bank on planet Earth that has $100 billion in assets to cover the losses of all the client money that they just borrowed. So again, this is the double edge of leverage. Banks borrow your money to buy government bonds, and when those government bonds depreciate, they lose much more money than whatever they could ever pay back. So I'm a huge bear on the banks. Don't be surprised. I believe banks will continue to go lower over the next couple of years. So that does it for me for today. If you guys have any questions, leave a comment below, because I'd be more than happy to go ahead and answer some of them. And yeah, keep watching my videos, because I'm pretty sure there'll be a lot of great information for you guys later on down the road.